Hello, welcome. This is Seewing Yee from the Yee Real Estate Network. I'm going to share with you how to optimize and build your real estate portfolio empire. Again, thank you for watching. So without further ado, let's go through the share screen. Now, this is two scenarios. If you are a savvy investor and you want to do a 1031 tax deferred exchange, and we have assisted many California investors that have done 1031 tax-free exchange from California to other state markets, and you know who you are. So many of you over the years have achieved a massive equity on your real estate portfolio in California. However, the cash flow is very minimal, and you need to scale your portfolio. Many of you have done your 1031 tax-free exchange, selling your one California real estate property in exchange for 5 to 10 out-of-state properties in great markets in the South and Southeast for much higher cash flow, much more diversification and asset allocation, and multiple streams in income and so forth and so on. The other scenario to do this ideal turnkey rental property portfolio acquisition is for brand new investors. I know I have created this blueprint over 20 years of assisting with real estate investors, and we can help you do the same thing. So if you're really ambitious, if you're really committed, so you need to buy multiple properties. Our formula would be you buy 10 properties in the next year or the next couple of years on a systematic basis. Some of you can do it. You can buy several properties at a time. And then in about 12 to 24 months, you have your ideal 10 or more real estate properties, right? So that's the ideal goal. So without further ado, I know everybody's situation is different. I know everybody's goals are different. Some of you have more financial resources. Some of you have less. But all I can say is I'm showing you the potential blueprint, the ideal way to scale your real estate portfolio. And by the way, even if you build up to 10 properties or more, you do not need to spend too much time. It's not even a part-time job. It's a less than a part-time job because you're using a turnkey approach. You're going to delegate using a professional property management in those markets, and you'll be surprised and shocked how this is very much doable. And the most, even if you have 10, 20 investment properties over time, the time you need to spend to so-called manage your portfolio is no more than a couple of hours per month. You heard me, a couple of hours per month at the very most, at the very least. All right, so here are the potential 10 property investment methodology, asset allocation, the type of properties, right, and what have you. So I'm just going over the high level, 10,000 foot level to share with you, and then I'm going to recap and to picture down the road what you can achieve to achieve your financial freedom. Thank you so much for listening. So here we go. Yes. This kind of property doesn't have to be consecutive, doesn't have to be, you can mix and match, but I'm not gonna go over the numbers too much, just from a high level basis. Otherwise, we can spend many hours doing this presentation. So your first property, for example, again, everything will be based on a 20 to 25% down payment. I know don't discuss any details like interest rate. Yes, I'm projecting interest rate to be 5.5 to 6% interest rate, and still that should not be a red flag or issue. So because as a risk investor, you need to look at the big picture, how to invest over time, right? So with that in mind, your first property potentially could be here in what location? In Florida, Southwest Florida, Cape Coral. The single family home, $385,000, new construction, and the projection rent is $2,500. So that interest rate 30-year fixed rate mortgage of 6%, giving a 25% down payment. So your total out of pocket is $108,000 down payment. And then you do the monthly projection at $2,500 monthly gross rent minus your debt obligations. And at the end of the month, you have a slight positive cash flow of around a little bit less than $100, right? As long as you have some positive cash flow, everything will take care of itself. I will explain later toward the end of the presentation why real estate investing, why income property. There are multiple ways to make money on a rental property, even though your cash flow is not as high as you expect. So keep that in mind, all right? So that's your first purchase, all right? And I don't want to go over the numbers too much, but you can take a look at it yourself. The numbers are pretty much ideal, right? So you expended your first 100 grand for a down payment financing on your first property here in Southwest Florida, and your second property, you will diversify into another market, in Central Florida, an hour above Orlando Metro. There's a booming town in Ocala area, next to the Villages, which is the largest retirement community in the country. So very fast growing, and the prices there, at least for right now, is very, very inexpensive. A very great value. You can buy a new construction home there for a mere $233,000. Brand new single family home, 3-bedroom, 2-bath, 1,300 square foot, as you can see. And the rent is estimated to be $1,750. So very good rent to value ratio at 25% down payment, again, at 6% interest rate. And your total down payment is approximately, how much here? Around $58,000 plus $2,000 closing costs. So total out of pocket is $63,000. And based on a $1,750 rent, then your monthly net minus your debt obligation, taxes, insurance, park management fee, and then your monthly mortgage, you still cash flow at $236, so which is very good. This is just only your first year projection, all right? Keep that in mind. Right, so that's the end of the second property. Your third property in Palm Bay, Florida, which is the Space Coast, 1 hour east of Orlando Metro. Again, $310,000. The rents for $2,200, and then 25% down payment, $83,000 out of pocket. You will receive a positive cash flow around $330 something. And the rest of the numbers really are good. I'm not going to go over that. The cap rate is very ideal, as you can see. The cash on cash return is a good benchmark, and then your return on investment is a whopping 46% based on 10% appreciation. Who knows? All right, so this is your third purchase. That's the end of Florida. So again, this is a 10 property portfolio. So your fourth property is a hybrid market, is in Alabama. This is new construction, very good price at $250K. It rents for $1,650. You put 25% down payment, total out of pocket is $52,000. Positive cash flow monthly, net positive almost $200. All the numbers really make sense. Okay, we got a 25% down more, 25% mortgage, as I said. So let me speed up a little bit. So very good area. This is in outside Huntsville, Alabama, very fast growing. The prices are relatively low. And then your next purchase would be in Central Texas, in Houston, actually, some brand new construction, duplex. See, you can do from 1 to 4 unit, ideal situation, 1 to 4 unit. Each investor can do 10 mortgage under the Fannie Mae lending guideline. A duplex, such as in this case, only equal to 1 mortgage. So you got 2 doors, the only is down as a 1 mortgage. Triplex and fourplex, up to fourplex is still 1 loan. All right. So again, $500K duplex, 2 doors, down payment 25% down, $131,000. Positive cash flow, a few $100. That's fine. All right. Brand new construction in a very fast growing Houston or Dallas metro area on this brand new, great high value duplex, a very good A+ location. And then your next property is in Raleigh, Durham, North Carolina area, even Charlotte, similar price range is, in this case, $390,000 a resale home. Very good area, very fast growing, high-tech market here in Raleigh, Durham, North Carolina, and then you put 25% down payment. So your total out of pocket is $123,000. So your rent around, how much is it? Your rent monthly, your gross rent is around $2,600. At the end of the day, minus your mortgage, your monthly cash flow is $128. So then your next property is in Niagara Falls, Buffalo. This is a cash flow market, either Midwest. So there's a good stable cash flow market, higher cash flow return, but it's an older, much older property, but it's turnkey, all rehab for you. So this case, this is a single family home, $69,000. It rents for $750. So you put 20% down payment, you still cash flow $141. Okay, and only 20% down payment with a 6% mortgage rate. So you can offset your lower cash flow, higher appreciation market in the South and Southeast, which went over, and now you can buy some Midwest properties, in this case, Buffalo, Niagara Falls, with a higher cash flow to offset your lower cash flow market. Does it make sense? That's how you diversify geographically. You diversify among the type of properties, single family home, one unit or duplex or fourplex, right? Then you diversify among higher cash flow versus low cash flow and what have you, right? That's how you build your portfolio. You diversify, just like any other asset class, right? And then the next purchase is a duplex in Niagara Falls at a mere $92,000 approximately. And it rents on both doors for almost $1,200, $600 per door. So it's a very good rental value ratio of over 1%. So you put 25% down payment, then you have a positive cash flow of $273. See, a little bit higher cash flow, much lower price on a duplex. This qualifies as a one mortgage. Your down payment is only like less than 30 grand, right? So just keep that in mind. And then your third property in Niagara Falls is a triplex, 3 doors, 3 units for only $149,000. Turnkey, all rehab, renters in place, all 3 units combined to rent $1,700 for all 3 doors. Then you do the at 25% down payment. Then all the debt obligations are included. Then you have a monthly net cash flow of approximately higher than $300. And finally, your 10th property is also in Niagara Falls. Is a duplex, right, for $92,500. And then the monthly rent is almost $1,200, around $600 per door. And then at 25% down payment, your total out of pocket is only 30 grand. And then you at the end of the month, you get a monthly cash flow of $273. So you're buying, several multi-units in the Midwest type of cash flow market to offset the newer construction, lower cash flow, higher appreciation potential in the South and Southeast, in Texas and Florida and North Carolina. And then at the end of the day, let's recap this, how you scale this property, this portfolio. And let me just, the recap is at the end of the 10 property or more purchase, it values at $2.5 million. Your 10 property, if the initial valuation is $2.5 million, total cash out of pocket. I know some of you do not have $700,000, but many of you do have it. And over the years, I have worked with a number of you that have achieved similar asset allocation, similar ambitious real estate portfolio acquisition strategy that I'm sharing with you. And then, of course, you leverage everything using loans, 20 to 25% down payment, Fannie Mae lending guidelines, 10 loans, 1 to 4 units equal each loan, right? That is your scenario. And the beauty of it, if you invest for the long term, here are the potential multiple exit strategies, right? 5 to 10 years from now, you will beginning to reap some of the financial benefits of creating, scaling this portfolio. And of course, you have to work with your team of financial professionals, your loan agents, if you will, or you can consult with the one we have within our network. In the next few years, given the how fast your property will grow, each location is different, of course. No one can predict the future, but somewhere along the way, around 5 to 10 years mark, some of your property, you'd be surprised, you may have achieved a fair amount of equity. You can cash out refinance some of those equity from your rental properties and leverage more, and then buy more property, leverage into more rental properties, grow and scale your portfolio. When you do a cash out refinance, as I said earlier, you do not pay taxes. That's the beauty. Or you might want to do a 1031 tax-free exchange at some point in time, sell some of your portfolio, right? And not pay capital gains as long as you buy replacement properties within 45 days. To identify the replacement property within 180 days, you can consummate the deadline closing of the replacement properties. That way, you do not have to pay capital gains when you leverage your current portfolio into who knows, into multi-units, into apartments, into syndications, into different type of investments, and not pay taxes on it. And then, or within your initial 10 properties, if you want to receive more cash flow, more passive income, if you want to accelerate, if you want to retire within 10 years or so, within 7 to 10 years, what you can do, now everybody's situation is different, you can make one extra principal per month on each of your mortgages on a systematic basis. That's a domino effect. When you pay one extra principal per month on each of your 30-year mortgage, each of the mortgages can be paid off in 7 to 10 years. Think about it. You have 10 mortgages currently. If you merely, you're getting the cash flow, right? I mean, you don't need the cash flow right now. You're not ready to retire yet. So what you could do is use your monthly positive cash flow on the underlying debt and the underlying mortgage and pay off the principal, one extra principal per month, and all your 10 mortgages can be paid off in 7 to 10 years. And then you can have, and then over the next 10 years or more, you can keep raising your rent. So your cash flow can be higher. So imagine when you paid off all your mortgages in 10 years or less, then you have no more mortgages, you're debt free. We can make the argument that each property you own, you have at least $1,000 of monthly net passive income without any debts, right? So just do the math. At approximately $1,000 or more, because you could raise your rent, every year 3 to 5% or more, depending on each market, each property, each neighborhood. Just do the math. 10 properties multiplied by $1,000 monthly net passive income without any mortgages. You have $10,000 of monthly passive income to live within in your retirement, whatever is the definition of your retirement. Or I mean, some of you do not you don't want to become a landlord anymore at some point in time. There's nothing wrong to sell some, if not all of your rental properties, and pay capital gains, pay 20% capital gain, whatever. At the end of the day, you still have a very good profit. So nothing wrong with paying taxes, even under the worst case scenario. And finally, another scenario I didn't really mention is that you can hold your properties for the rest of your life and beyond. But when you pass, your property will be going to achieve step up in basis. Again, I'm not a tax advisor. I'm not giving you tax advice. Consult your financial advisor accordingly. But when someone dies, the asset value is the fair market value at the time of death. So what does that mean? That means there are no tax consequences because your beneficiaries, your loved ones, gonna inherit your property without paying any taxes, right? Because when someone dies, the properties at its value, at the fair market value at the time of death. So from the original cost basis of your initial property you bought years ago, all the increases in value, there are no underlying capital gains or gross income tax you have to pay from your estate, right? So that's it. There are so many multiple strategies, but most important thing of all is you gotta take action, right? You gotta go through the blood, sweat, and tears of systematically buying the investment properties, scale your portfolio, hire your team, hire your property management, hire a turnkey system out there in the marketplace, and we can help you as well. Right? So is it easy to do? Of course not. Is it doable? Not all of you have $700,000 cash to leverage your mortgage into 10 properties or more, right? But if you have less money than that, you do it, take longer, right? You buy 1 or 2 properties per year if your financial resources are limited. But many of you have them kind of money to buy quickly, to build your portfolio, scale your portfolio within the next 6 to 12 months to buy your 10 properties. You can do that. I have helped many people do that. Okay, all right, that's all I have to say. Hopefully this big picture, this ambitious portfolio acquisition makes sense. This is real, it can be done. Also embrace this philosophy and just be courageous, just be ambitious, just commit to your goals and make it happen, take action, overcome fear, whatever it takes. Thank you so much and good luck and have a nice day. This is Seewing Yee from the Yee Listening Network. Thank you so much. Bye-bye.